Welcome to the Westside Investors Network, WIN, your community of investing knowledge for growth. This is the Real Estate Professionals Investing Podcast for real estate professionals by real estate professionals. This show is focused on the next step in your career, investing. Thank you for listening. And please, if you like our content, rate us on your podcast provider. Just a quick disclaimer, the views and opinions expressed in this podcast are for educational purposes only and should not be construed as an offer to buy or sell any shares or securities, make or consider any investments, or take any other action.
Welcome back to another episode of the Deal Deep Dive segment on the Westside Investors Network podcast. I'm your host, Trent Werner. In this segment, our featured guests will share their unique stories on a specific deal they've invested in. We will dive deep into finding the deal, financing the deal, writing an offer, and the due diligence. Do us a solid and smash that subscribe button, leave us a rating, and share this episode. And now, let's dive deep. Welcome back to the Westside Investors Network podcast. I'm your host, Trent Werner. Today, we are joined by Vanessa Alfaro, the founder of Venus Capital. We're going to hear about Vanessa's entrepreneurial career in marketing, where she started 3 different businesses in 3 different countries before founding Venus Capital, a real estate syndication company. We're also going to hear about Vanessa's 96-unit deal in Missouri that's currently still active and going through a refinance as we speak. Now let's welcome Vanessa Alfaro. All right, Vanessa Alfaro, welcome to the Westside Investors Network podcast. I am super excited to hear about the Missouri deal that is going to be talked about a little bit later on. But before we get into that, I'd love to hear about your entrepreneurship journey that includes multiple businesses across multiple countries, and not all of them are real estate, which is fun to hear on this real estate specific podcast. So Vanessa, thanks for joining us.
Thank you. I'm super happy to be here. We rescheduled this a few times. Okay. I was sick back and forth. So this is one of the podcasts that I've been willing to and excited to be on. So thank you so much, Trent.
Of course. And anytime we get a very successful entrepreneur on the show, I'm excited to actually get this conversation going. Like you said, we did have to reschedule a couple times, but it was worth the wait. Vanessa, you didn't start directly into real estate like a lot of the guests on the show did. Where did you start your entrepreneurship journey and what industry were you in?
I was actually in the marketing industry. So I started my first business when I was 22 years old, and I finished my career. I was actually a single mom. My daughter was 2 years old at that time. I decided I just didn't want to work for anybody else. Okay. And it was very risky because I didn't have money, or I didn't have like support for me to say, well, I'm safe, okay, and I can raise myself to start a business with a child. But I did it anyway. And I think that that's one of the characteristics of an entrepreneur. We are so willing to put at risk our security. Like, I don't believe that there is one entrepreneur that is really entrepreneur that is not take that amount of risk, right? So I started that company, and that was a marketing company, because even though I was in business school, okay, before business school, I was in physics. So I wanted to be an astrophysics, right? That was my dream. I'm a nerd inside, very nerd. I like, you see my library books, like I have physics books, quantum physics, like everything about that. So, and then I went to business school because even though I'm a nerd and I love physics, I love numbers, I also had this huge desire to do something and be an entrepreneur and make my own business and also make money, because I didn't come from a family with money. And I always was concerned why we can't do this, why we cannot buy this, and blah, blah, blah. So I wanted to do my own business. I went to business school. And then in order for me to pay for my college, okay, I was working as a model. So I was doing runway or whatever gig I could get, okay. I was a full failure as a model, okay, full failure. I was barely paying my bills with what I got, but that was the industry that I was. So for me to start a business in marketing, it was very natural because that was the environment that I knew, okay? So I started my first company in marketing, and then my second was in marketing as well in a different country. I was born in Venezuela, so I speak Spanish. That's my first language. And after that, I went to Panama. I opened another marketing company and a trade show company with some other partners. Okay. More than a decade ago, I moved to the US. My husband and I has a production and a publishing company that is focused on the automotive industry in the US for the Hispanic market. So it's very, very niche. And then at one point, I decided to move to real estate just because I believe that as an entrepreneur, you have that risk, but you also have to have passion. And what happened is that when you lose passion for what you're doing, that's a sign that you need to move to another company. You need to scale another company. You need to start something because at the end, okay, that passion is that drives you as an entrepreneur.
Yeah, I love that because I mean, if you're not passionate about it, it's just like any job, right? Whether you're a W-2 or an entrepreneur, if you're not passionate about it, it's really hard to be successful in, right? And obviously you had passion in the marketing realm and niche, and eventually that maybe burned out a little bit, or you kind of felt like you reached your plateau, and all of a sudden you wanted a new challenge, a new endeavor that you can learn and grow yourself in, right?
Yes. And can I tell you what is exciting about real estate?
Mm-hmm.
Is that every property is like a new business.
Yep.
Each deal is a new business plan. It's like you're starting a new business, and it's the whole process of completing a business plan. So you find the deal, which is the product, and then you create a business plan. What are the projections, numbers? What are the people that is going to work there? What's the marketing plan to bring that to success? Then you bring the investors into that property. It could be with a fund or just a syndication. And then you execute that business plan for 5 to 7 years, and then you exit.
Yeah.
You go and go to another one. So it is, as an entrepreneur, it's very exciting because for me, it's like each deal is another business. So I literally have 15 deals. I have 15 business on my plate right now.
Exactly. Well, and with your marketing experience and creating businesses in the marketing industry, you already had that experience of starting from the ground up, executing a business plan, and going full cycle, with those companies. And so, to your point, you're just doing that more frequently in syndications and real estate, right?
Right.
Yeah, that's awesome. So, what aside from real estate intriguing you, was there any one thing or a few things that all of a sudden you said, you know what, I want to go take some risk in real estate? What really got you into syndications?
Right. So what everybody that is listening here, if you are if you're in real estate, okay, usually you got into real estate because you want generational wealth, you want passive income, okay. You don't want to just have a job to yourself. You want something that is creating income for you, your kids, or everybody has their own what, right? And when I decided that I didn't want to be in the marketing or in the business that I have with my husband anymore, okay? I mean, I didn't want to be in the business, okay? Then we always thought about real estate. We always thought about, hey, there is wealth in real estate. We should go and buy real estate. And my husband family always had real estate in Panama. He's from Panama, and they created their wealth with real estate. So we were always talking about that. What if we go into real estate? And my answer was like, we need to learn really how to do this, because I'm sure that there is a formula, and we just don't go and buy. And I do believe a lot in, these personality assessments and understanding how everybody looked their model of the world. And my husband has a very similar way, but not similar, a very, very not similar way than me to look at the world. Okay. I think that's why we complement each other. He is the kind of person that he likes to feel people. he likes to feel the property. He wants to see the place. So he will be one of those persons that go to the place, and if he like it and he thinks like he get a feeling that he's going to make money, he goes and he buys. Okay. I am completely the opposite. That I'm very analytical. I don't even want to look at that place. Okay. Don't even take me there until I see the numbers and see what is really happening in that place. If I see that there is potential, then probably I will go and drive. Okay. I will probably do that first online, so I won't spend my time. So I am not attached to that feeling, okay, or connection that he may be. So we decided, okay, let me study and learn how we're going to do this. So I went to one event, and it makes sense to me. And as you know, I am a total nerd. I love numbers. And when they start talking about underwritings and numbers and accounting, I was like in love. And that's how we started. Okay? And I decided I was going to go to that route, and I was going to develop that part for us. Okay? And he was still managing the other company. And I always joke with him that I am just his tax look. That's what I am. I'm just your tax looks. So you make money, and I just make sure that we make it tax deductible.
So with your husband's experience in real estate, your team had that background. Obviously, you have the business side, no?
Not really. He didn't have experience. His family make money. His grandfather makes money. He had no experience at all in real estate. And that's what scared me a little bit, even though I'm a very risky person. Okay. But I am risky, but I know that there is something that we need to learn. It's just don't go and buy a property. So I knew that. I was like, this is what I want to do, but I want to learn. I want to make sure that I know what I'm doing, because at that point I was learning about syndication. That doesn't exist in Latin America. At least I didn't know that exists. So we were learning about syndication, and when you're playing with your money, it's one thing. But when you are taking others people's money, okay, that's a whole level of responsibility. And I want to make sure that I knew as much as I could. So I learned, I paid for a coach. I still have coach after 5 years. I keep learning all the time. But and I partnered with people that had more experience than me. So for my first 3 years, I just partnered with people that had 20 years of experience. They're still my friends. So I still keep asking the question. I think that we never stop learning on this business as well.
Well, yeah, and to that point, that's why I enjoy real estate, is because every deal is different. Every deal has new challenges, and it's exciting to be blunt about it. It's just, I love solving puzzles, and each deal is a puzzle that we get to solve.
Great entrepreneurs are the ones that solve problems. And I do believe that the only problems that cannot be solved are the ones that are guided by the laws of physics. Mm-hmm. So, but everything else can be solved. So I'm sure that you're a great entrepreneur.
So now we've heard about, your career leading up to syndications. We're going to talk about a 96 unit deal in Missouri today. We were chatting before we started recording, and you asked, do you want a deal with a lot of hair on it, a lot of troubles, or do we want a success deal? This one is one that you're still working on, from what I understand, and it has been a success to this point. So let's talk about when you bought this deal, this 96 unit in Missouri, why you guys wanted to buy it, and what the plan was for this project.
So we bought this deal about almost 3 years ago, and we found it from a good friend of mine, a small broker in San Luis area. And the reason we like this deal is because it had a lot of value add. The rents in the area were very, very low. We're talking about $500, $550, when the area, there was a $850 at least. So it was a lot of value add. And the deal was late 70s, okay, something that we usually don't buy. We like 80s, 90s product, but there was such value add and the price was right. We bought it at probably 45,000 per unit. We, of course, had some issues with the deal because the deal had aluminum wiring. So we have to remediate that. We have to deal with insurance that, of course, when you buy a property with aluminum wiring, you have a very high cost on the insurance. And then we have to reinsure the property in order to lower the cost of insurance. But we had a great price. We were in a very good area. I remember we, of course, drove the property before we purchased the deal. And the area was really good. I was really surprised that that deal was in the middle of a B area. Okay, it was a C deal in a B area. And the seller was really not sophisticated. So he didn't have a property management. He had a very good girl working there. So it had all the check box mark for us to get a really good return for our investors. And my partner, he came at the beginning. We wanted to buy that deal in an agency loan. So the plan was just let's buy this deal. It was almost $5 million. And then the whole renovation was going to be $1 million just to renovate the deal. Let's buy this deal and let's keep it for 5-7 years and then we sell it. But then he is also a mortgage broker, my partner. So he's the one that do all most of my lending. And he came and he said, listen, this deal qualifies the perfect example for a bridge loan. So we're talking about 2.5 years ago when everybody was buying a bridge loan.
Yeah.
And he is a very conservative guy. He's very conservative. He would never tell you to buy something a bridge loan if he doesn't really feel it's a bridge loan. And I asked him, listen, everybody's buying a bridge loan. I think that's very risky. And he told me, this is the reason why this is actually the deal to buy in a bridge loan. Like, this is the amount of renovation that you need. You're actually flipping this. The value add is really high. You can prove that you can increase these rents, and in 2 years, the value is going to be to the roof. We can refinance this deal. Now, 2.5 years ago, a lot of syndicators were buying deals in a bridge loan just because they wanted to buy in a bridge loan, because they wanted to get higher leverage on the deal, but not for the real reasons that you buy a deal in a bridge loan. Does that make sense?
Yeah. They were, I mean, from my understanding of it is a lot of people were trying to use bridge loans to juice returns when, to your point, it probably didn't make sense to do that.
And now here's a word from our sponsor.
Get things done while you're on the move. Learn more about working with a virtual assistant through Offsite Professionals. It's a great way to get all the things done that you need to get done. Have freedom in your time and streamline your life by automating your business. Stop spending time on the tasks that you can delegate and start spending more time on your superpower. Call us today at 503-446-3177 or visit our website at offsiteprofessionals.com.
Uptown Syndication is now offering a syndication coaching program for you to take your real estate portfolio to the next level. This is your opportunity to have experienced syndicators, AJ and Chris Shepard, coach you on your way to controlling your real estate investing future. Our coaching program will provide you with the tools and framework needed to begin syndicating real estate in your target market. Go to uptownsyndication.com today to learn more.
It didn't make sense. Everybody just tried to get more LTV from the deal. So they get more money, they raise less money, but the real basis of really buying using a bridge loan, they were not there for the deal. Okay, they were just expecting that in 2 years, the cap rate was going to be more compressed and they were going to be able to refinance. So they were betting, let's raise less money, let's get more leverage, and the cap rates are going to keep going down, and then we're going to refinance. So they were betting that in the future, the cap rate was going to be lower than what they're buying, And that way they were going to make money. But the basis really, they were not there in the deal.
Mhm.
In my case, the basis of getting a bridge loan were there. We had all the boxes checked. So we went into a bridge loan, we purchased the cap. So by the time the interest rate went to the roof, we had an insurance that was able to cap our mortgage. And it was a very difficult transition for the tenants because we're talking about $300 and $400 in rent increase. And it was, I mean, you're talking about people that probably lived there for 10 years, you know? So there is also a human side there of how you're going to communicate this. How can you help the people that is there? How can you help them to go to somewhere, to another place? There is also, it is important to understand that we are talking about the homes of people that has been living in those places for so many years, right? So we managed for 2 years, okay, to do most of the transition. I would say that probably 80% of the people was moved from this rent to probably they moved to another place. They use Section 8 to move to another place. Some people apply for Section 8 and stay in our deal. Right? But the result of that is that in 2.5 years, we were able to increase our income. For what we projected, we will increase more than 5 years than our business plan.
In 2 years.
In 2 years.
Yeah.
Okay. So I remember in the business plan, I know this deal very well because we're right now in the middle of the refinancing. So in our business plan, by year 5, we're going to have $842,000 in income. And by the end of second year, we were in 875,000, for example. So we went all above and beyond of our increase on income in the year 5 and year 2. Mm-hmm. Now, this is when the juice is coming. What happened? Okay. So what happened, even if we increase our income more than what we expected in 5 years, what happened when we're trying to sell or refinance the deal if the cap rates are not compressed anymore, but the cap rates expand in some way that in some places the cap rates are probably from 6 to 7, 100 points more, probably more. We're talking about interest rates are probably 6 right now. They were 6.5 a few months ago. So we're talking that the cap rate in that city went from a 6 to a 7.5. So now when you analyze the deal at this point, and we do have a bridge loan that is 3 years. So our business plan was always refinance the deal and actually keep the deal until year 5. That was our original business plan. Now, at this point, we have a higher income, we have a higher NOI, but we do have a higher cap rate. And even though with the income of 5 years, with the situation that we are in the economy, the value of the deal is not enough for us to sell the deal. So if we want to sell the deal, we were in a different situation, we will be making 2x of the money because the cap rate would be probably 6%. But now we can't sell the deal at 6. We have to sell probably at 7 or at 7.5 because of the area. And that means that the valuation is lower. So even for good syndicators that has been managing their deals correctly, and they have been doing everything right, like what's happening in the environment is affecting the way that we are executing our business plan. So in a separate times, I will sell the deal. Now we can't sell the deal right now because the cap rates are too high, and then the price is not there. Now we're trying to refinance the deal, and now we're in a very good position to refinance the deal because we increase the NOI at that level.
Right.
So it's a very interesting deal that I wanted to talk about because we still haven't finished, okay? But that analysis of what's happening right now is affecting so many deals that it's important to bring the attention. And my investors are extremely happy. They know what is happening. And now if we keep doing what we're doing, now in 5 years, probably things are going to change and we're going to keep increasing our NOI, and we're going to be able, even if the cap rate does not compress, we're going to be able to exit successfully. We just have to wait. Does that make sense?
Yeah, of course. And so in those first 2 years, I know you said you had a $1 million CapEx budget. In those first 2 years, obviously you talked about turning over tenants and all that stuff. What were you doing in terms of CapEx in those first 2 years? Obviously, increasing rents is part of the business plan, but in terms of construction or remodel, were you guys doing anything in those first 2 years to the units, the exteriors, anything like that?
Sure, we did a lot of exterior work, stairs, some parking lot. It was mostly exterior, and for the interior, we had a plan of renovating 80% of the units. And with those units, we're going to do very basic renovations based on what our comps actually shows, right? So when you're doing this business plan, you always bring what is happening around you in order for you to bring that rent to that level. And it was actually not really a lot of things that we needed to do to the units. We needed to paint the cabinets. We wanted to put the flooring. We wanted to do the resurface. And we'll have to change some of the appliances that were very old. But the comps were not showing that we needed to do more than that. So we needed to go, we didn't have to go and buy black appliances or like high-end appliances, or go and put a lot of technology in the building in order to achieve those rents. Okay. And every syndicator, and if you're managing deals that you have a long-term business plan, you always have to review your business plan. Yep. So you always have to go every 6 months and see what's happening around. That's how we were able to increase the rents to year 5, because we're always checking, okay, how are the other properties doing? Are the other properties increasing? And we saw that the market was increasing 9% year over year. 9%. That was really high, where Austin is going negative. This market is still increasing 9% right now.
Yeah.
So you always have to review what other properties doing, whether they adjust your rents accordingly to the market. And we realized that we didn't have to over renovate or overspend in order to get to those rents in that area.
And then you mentioned aluminum wiring. What did the insurance require you to do, or what did you decide to do in terms of the aluminum wiring throughout the complex?
Well, we always work towards the plan of refinance the deal with an agency loan. So we want to make sure that whatever remediation we're going to do in aluminum wiring, that was according to Fannie and Freddie stipulation. So that's what we did.
Okay. So you didn't have to go in and rewire the entire complex?
No. Actually, they don't require you to rewire the whole complex. They require you to use a specific way to remediate the aluminum wiring.
Got it. Okay. And so you've talked about the value add component of this project. When you were analyzing and underwriting this deal to begin with, I'm sure you had a projected value at 5 years, based on your NOI at that time. Obviously, you hit the NOI target way before 5 years. What's your plan after the refi? And did you hit that projected? Obviously, cap rates went up a little bit, so maybe the value isn't what it was projected to be at. But where do you go after the refi, and how long do you anticipate holding this project now that you're going through the refi in year 3?
Yes, we usually increase our cap rate for 1%. 1 point. So we bought a 6, we wanted to sell as probably 6.75. Okay. We go in between 50 to 1 full point, okay, in the underwriting, depending of the area. And as of right now, the cap rates does not allow us to sell at the price that we want, okay, in year 5, but allow us to refinance and get a very healthy, refinance and cash in for our investors. So our investors are going to get some money, okay, in their pockets. Okay?
Yep.
So we can cash out some investors. And then we're just going to keep it. We're just going to keep it for 3 more years. Okay. Our business plan was 5 to 7. So we still have time. And that's why we are very conservative when we're putting together a business plan. We always allow us enough time for us to implement the business plan, because at the end, you don't know what's going to happen. You don't have a crystal ball, right? So you have to be as conservative as you can. And it was very hard for us to raise money 3 years ago. And I'm going to tell you why. Because we were competing with people that had crazy projections, like crazy. Just come here, I'm buying this, stay for 2 years, and I will pay you 3 times your money, something like that. And we were talking to people like, hey, we have this deal. This is at 22% annualized return. You stay between 5 to 7 years, and you get a 7% preferred return. And they were like, but how is that possible if I can invest with X syndicator and I can get 3 times my money, and then I will be there just for 2 years and then I'm out? It's like, how can we compete with that? So we are very lucky to have investors that are very savvy, okay, and they understand how we look at things. But 3 years ago, it was really hard for us to compete and raise money and put in front of an investor a plan where they will make the same amount of money in 5, 7 years that with another one in 2 years. Now, what's happening with other 2 years, those 2-year plans, that's another story that I don't know.
Yeah.
But you can see in the news many of those properties has been taken back to the bank. I do have one deal that is actually in a lot of trouble with the management team and with the bank, and we're now negotiating the deal with the bank so we can sell the deal. But except for that, all my other deals were 5 to 7 years. So we're very lucky to get our investors, okay, that trust us and believe in the way that we do things.
Well, and one thing, like how we operate, is we're very conservative when it comes to our projections, our underwriting, the whole 9. And I think that's why we have a lot of repeat investors, is because, they could go find a 25% IRR in 2 years, 3x multiple, whatever it may be. But that's a lot more risky than, what we're doing, what we're offering. And I think a lot of investors, especially the ones that are, want to just get exposure to real estate and not do development opportunities or whatever it may be, they feel more comfortable with something that's already standing, already generating revenue, because it's not, a development project that's already in place. And they feel more comfortable with that conservative investment versus, some of these developers or heavy value add with high leverage type deals.
100%. And I will agree with you that a very good metric of how your company is doing is how many repetitive investors you have.
Yep.
So
Absolutely.
if you have 80% of your business are always new investors, I think that's a problem, because your investors are not sticking with you. But on the opposite side, if you have 80% of your investors either coming back or through a referral system, that takes a lot about your company and how you do things and how you manage things.
Absolutely. Well, Vanessa, I appreciate you sharing about your Missouri deal. Is there a way that people can hear more from you, read more about you, connect with you on all the different socials or websites?
Sure. In my website, if you go to my website, it's venuspartners.com, venuspartners.com. I do have a lot of resources. I have a section with an ebook that we have created. We're very into technology, very into artificial intelligence and ways to use technology to optimize our processes and actually to optimize the deal itself in order to create more return to our investors. So you will find in my website a lot of resources and ebooks about how you can use AI, how you can use it as an entrepreneur. I have 5 tools that you can use right now for you to save time in your business. And also, if you are a real estate investor, I do have another that have a little bit more of tools that you can use for your business as well. So I invite you to go and check the website and download one of those ebooks and see if that creates value for your business.
Love it. We'll make sure we link venuspartners.com in the show notes and in the description here. Vanessa, again, thank you so much for joining us today and telling us about your entrepreneurial career as well as your real estate syndication life.
Thank you so much. Really a pleasure to be here.
Thank you for listening to this episode of the Real Estate Professionals Investing Podcast on WIN, your community of investing knowledge for growth. We hope that this episode has increased your knowledge and added value to your path to freedom. If you would, please take a second to rate us so that we can get more great investors to interview. If you or someone that you know wants to be on, please visit westsideinvestors.com and fill out our form to be on the show. Thank you again and enjoy your day.